John could talk about that, how a little bit more, how we have the public equity and the private go together, and there's more of a buffer each year. But if the TSX is up 30%, probably not going to be there, to be quite honest, in my opinion, like in terms of all our portfolios combined together. But we're trying to grow individuals' capital over the long term, not any one particular year, even though we want to compound it every year. And I don't know, John, if you have something to add to that.
Yeah, I mean, I think we really saw that in 2022, which was just like a horrible year in stocks and bonds because of rising interest rates. The S&P 500 lost 20%. Most bond markets are down 10 to 20% as a result of rising interest rates to deal with the effects of the post-pandemic inflation. And, a lot of our portfolios were sort of flat or just down a couple kind of percentage points because of portfolio construction on our publicly traded equity side of things in the three portfolios. And because our private asset portfolios were all up between sort of 4 to 9%. And so when you have some portfolios that are generating positive returns relative to sort of negative returns and bonds and equities, you really end up outperforming and preserving capital. And look, that's just how things work. You get some years, it's virtually guaranteed, where they're going to be bad years from investing, and you get some years that are going to be great. You're going to have, time has shown, history has shown, you have way more good years than bad years. But the bad years happen. They will happen. It's 100% guaranteed they'll happen. We all wish we knew when they were going to happen. Every client asks that, as you all know. Nobody knows exactly. If you make enough forecasts, you get some right. It's like there's some famous investors out there, famous economists, famous like economists, where the kind of line is they've kind of predicted 7 out of the last 3 stock market downturns.